What is up, everybody? Welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I have my co-host here, Kyle Ryan, as always. And today we are bringing on another guest, Sean Robinson. Thank you for joining the pod, Sean. Sean is an insurance agent with Brush Creek Partners. He's been working there in Kansas City here for the past few years. And we're really excited to bring him on because today we're going to talk about something that I think is probably talked about the least, Kyle, when it comes to financial planning is kind of property and casualty insurance coverage. So today we're really just going to focus on auto, home, and umbrella policies, and essentially just kind of the importance that that plays in the background, I would say, of your financial plan. But the way that I kind of wanted to walk through this conversation in this episode is the importance that it plays and the reasons that you need to be maintaining and updating your coverage as you're building out your wealth. Because I think that that's something that we see a lot of is, and Sean, I'm sure you see this as well, as somebody might, get out of college or get their first home and establish that auto, that home. They probably aren't even looking at the umbrella kind of off the front end. And then they start to build their wealth. They sell the first home, they sell the first car, and they go get nicer stuff. And the coverage doesn't necessarily change. And so Kyle, I'd love to just kind of get your thoughts kind of at the top of the episode on this topic and why you think it's important.
Yeah, of course. Sean, thank you again for joining us. Really excited to have you here. I've been looking forward to this episode for a while because, like you mentioned, it is an area of financial planning under risk management and insurance. But it's definitely one that, it's not my strong suit. It's definitely, it has a lot more layers than one would think. And,
yeah,
it's not something you think about until you have too little coverage. And, no one ever complained about having too much coverage in this. So, I'm excited to learn about, the gaps of what a lot of people might be missing, some pitfalls that we all might be, doing with our insurance because, we all like paying for the cheapest thing and paying as little as possible. But what does that lead to in the end? What are the consequences you're putting yourself for? So, yeah, like you mentioned, we're going to be starting off with talking about things like home policies, umbrella coverage, auto policies. So excited to dive in.
Yeah, and I actually made a LinkedIn post about this the other day. And it's essentially just this idea of like, as you're building wealth and you're buying nicer things when shit happens, it just costs more money, right? That's just like the reality of it to fix, right? And having that insurance coverage and having something that's comprehensive is so important. And before we jump over to Sean, just kind of want to quick disclaimer is we're having Sean on as an expert that's providing general advice. This is not an endorsement for Sean's services. But leading up to that, Sean, would love to just kind of start on the auto side. And if you could walk everybody through, if you have somebody come into you, reach out, and they say, hey, we're looking to take a look at our auto coverage and we want to make sure that everything is up to par. Can you just kind of talk us through how that process works with you, kind of some of the things that you're looking for, common things that you see people make mistakes on, and how you might go about possibly making changes if there's any things that you see, kind of like little idiosyncrasies with different providers. Just kind of walk us through that process on the auto side.
Yeah, absolutely. Well, thanks for having me on, guys.
Yeah.
Insurance definitely, and it's an integral part of financial planning, but it's definitely a back burner item. A lot of times, it's the thing that gets overlooked, but it's also the thing that occurs both sudden and accidentally. So in certain situations, you want to make sure that your clients are properly covered, and the premiums that they're paying on a monthly or an annual basis is providing them coverage for what they think is covered. So on the auto side, home side, really any sort of like personal insurance line, there's several kind of different ways that we look to when we're looking kind of like from a client, like holistically their risk profile. A lot of it depends on, what do you do? What are your true risk? What are your needs? Because, the student in college who rents an apartment and is just going to university is going to have a completely different set of needs than, a high level executive who's in his mid 50s that has, the kids in college. So kind of what we do on my side, just to tell you a little bit about Brush Creek Partners, is we're an insurance broker. So there's kind of two models, right? There's the independent side, which is what I work on, the brokerage side. That's where companies, insurance companies give agents like myself contracts to sell their policies directly. And then you have the captive model. So the captives are going to be all of the big names that you would see on TV, like your State Farm, your Allstate. That is essentially where the agent works for the company who they sell insurance for. So with State Farm, Farmers, they definitely serve a need in the communities, and the insurance that they provide, it just tends to be a little bit more kind of one size fits all because they can only give you that one product. Whereas on the brokerage side, we can offer a little bit more sophisticated coverages. Plus, we can kind of broker out things in the way to, to actually adequately fit somebody's risk profile. So just kind of going through, like, for somebody comes over for an auto, they just want an auto quote. It really, what we want to do is make sure, hey, your liability limits are adequate. And what is your true risk exposure here, right? Like, if you hit a pedestrian, are you subject to losing equity in your home, depending on the state you live in, right? Does that come into play? Do you have any retirement accounts that might come into play? Laws vary state by state, and depending on the state of where your accident occurs at, it just depends on what a personal injury attorney can actually go after. So
they'll go after it.
Oh yeah, they'll go after it. And so having adequate coverage is a necessity. So what we like to do is we always start off with just reviewing their current coverages. This doesn't matter if they're 18 or 80. A lot of people, they don't keep up on their insurance, and they put it in place when they're 20 years old or 25 years old or 30 or whatever, and they buy a new car and they just go back to the same person. Hey, I got a new car. And they just continually swap out their exposures without actually ever updating the true coverages. So in terms of like bodily injury, liability limits, uninsured, underinsured motorist limits, property damage limits, those are going to stay pretty consistent throughout each carrier, right? Like when I'm talking about like bodily injury liability, you're either going to see it written as a split limit, which you would see like 100, 300, which would be $100,000 of coverage per person, 300,000 per accident. Or you'll see it as like 300,000 CSL, which is a combined single limit. So that's kind of, we'll take a look at that and really just kind of try to figure out what their needs are. I mean, some people are just like, I want the cheapest thing ever. I don't care if it's the state minimum, I just want to, be on the road for as cheaply as possible. And that's obviously something that we would highly advise against doing. But there's that's a coverage that people want. So kind of going back to you guys, I mean, what are you wanting to see in terms of kind of looking over like auto insurance?
I just find it interesting. You kind of hit it at the end there, like I made the mistake early on that when you switch an insurance provider, and they're all the same, but they all market discounts, right? Come switch to us and we'll save you money. And the way they do that, correct me if I'm wrong, is they just offer you the cheapest coverage, right? So they just say, hey, come over to us, we'll put all your stuff together. And the advertised thing is just the cheapest, the smallest amount of insurance possible, and say, hey, we saved you money. We just gave you the cheapest package. And I remember I fell suit to that. I was like, hey, I just want to save every dollar I can. I still have insurance. Until you kind of look under the hood and realize how little and how liable you are if you're lucky to look under the hood before it's too late.
Yeah, exactly. So it's a combo of both, right? You obviously have the issue of just being able to go online and quote it yourself. So you have, just a massive amount of people that are buying insurance online and they don't know what they're buying. They look at the price. Oh, that looks great. Not knowing that, if they injure somebody in a car accident, they only have $25,000 for their medical bills. So
for people to understand, that is not a lot of money when it comes to medical bills, hospital bills. And when you're dealing with a car, if you nudge somebody, that can be dangerous.
Yeah. So in a situation like that, where you buy the state minimum, which would be $25,000 bodily injury liability per person, If you exhaust that limit, say you hit somebody and they have $100,000 in bodily injuries, the insurance company with that policy is only going to pay out 25,000. So where's the other 75 come from? Right? You're liable for it. And so, how's the court going to play this out? Are you young with the ability to earn income for the next 30 years? Because you could potentially have wages garnished. Do you have $75,000 of liquid cash to pay out? Because then you could drain an account that way. Do you have enough equity in your home where you'd have to maybe put yourself in a situation where now you're all of a sudden refining your house with a 7% interest rate?
Yeah.
Because you have to pull cash out to pay out because you didn't have adequate liability limits. There's a lot of different ways to go about it. So most of the time when we're looking at clients, we'll write with usually 250,000 of bodily injury liability limits per person, 500,000 per accident, and then we'll put an excess policy underneath to kind of add additional coverage on the back end for these catastrophic liability incidents. So we'll get into the umbrella stuff here in a little bit. But what a lot of people don't realize is when you're shopping your insurance around, carriers, they share all of their consumer data into a centralized database called LexisNexis. It allows myself and agents from all over the country to pull data on an insured. And so it's, when I go and I run a quote and I put your driver's license number in, your name in, your date of birth, it'll show me a report and it'll say, this insured is with this insurance company. They've been there for this long. They have these claims or these traffic violations. And that kind of gets calculated into what we would call an insurance score, kind of like a credit score, but they don't actually do like a hard credit pull. The insurance score is something that has a pretty big determination on a rate that you're going to receive with an insurance company. So when you pull data from an insured, when they have high liability limits like 250,000, 500,000, the carriers view that as less risky than somebody that just has the state minimum. So if you have a high insurance score and you have high liability limits, oftentimes you're actually rewarded with better rate tiering, which in theory, you might be paying less premium despite having 10 times the amount of coverage.
That's so interesting. So you're essentially saying that if the same person had the state minimum and then the clone of that person had that 250, 500 coverage, tried to shop quotes, the clone person with the more comprehensive coverage would technically be considered less risky. And what I mean by that is they probably just have the same, age profile, same number of claims, if any. Right. But because that second person has more comprehensive coverage, if they're shopping quotes, they're going to be viewed as less risky.
Exactly. It's all depending on the insurance history, right? So let's take just say, a 40-year-old who's had 25, 50 state minimum liability on and off. They purchase an auto policy and then it lapses. And then 2 months later, they buy another policy.
Yeah.
And they have it for 6 months. And then they get rid of that car and they're in between cars. So they cancel their policy.
Yeah.
Then they come back and they buy another car and they have that state minimum liability policy for a year. Okay, well, then you take that same person and they've just had the same consistent exposures. They've had insurance in force for 10 straight years. They have the highest liability limits. That person is likely going to receive a better rate tier than the person prior. That's kind of letting their coverage lapse. They're not making payments.
Yeah.
Coverage is canceling on them because in the insurance carrier's eyes, it looks less risky, right? This guy doesn't have any claims. He's been insured for 10 straight years. He's got high liability limits. He's got no claims, things like that. So that all comes into play on the auto side. But
can you talk really quick? Because I know that you and I have have had a conversation about this, but just if you could real quick, just talk through Turo and auto insurance, because I know that that's becoming a popular conversation. I know you and I have had conversations offline about this, but can you kind of talk about why there's kind of some hesitancies within the auto coverage industry to insure those types of vehicles that are getting rented out on Turo?
Yeah, sure. And it's not just Turo that we're seeing. It's DoorDash, it's
Yeah.
Uber Eats, it's Uber, just in
Yeah.
general, Lyft. Um, Insurance companies, when you are using your vehicle as a method to generate revenue, it becomes more of it's a business exposure.
Yeah.
Toro is unique, so they have their own coverage that they provide in the event that there is, an accident while somebody is renting your vehicle. Now, Toro does have coverage for that time when
Mm-hmm.
there's an incident, when somebody's renting your car and wrecks it or injures somebody. Um, and the same thing with like Uber and Lyft. Like if you're on a drive and you have a passenger, like there's those companies have like a whole coverage that will go over
Yeah.
and provide their drivers with that coverage. Now, where the gap kind of is on that is what happens when the car's not being rented, or when the car's not being, there's no Uber passengers in the
Yeah.
car. It still is, how is an insurance company going to view that? So
Yeah.
we've seen carriers over the last few years. Some of them add these endorsements, ride sharing endorsements, like do you use your car for to make deliveries or whatever. And you can sometimes endorse these on these policies, but that's something that you always need to circle back with on the client and make sure, because you truly don't know. And people, they have auto coverage, and then they want to do a side hustle, and they don't ever tell the agent about it, right? And so they
Yeah.
just operate with the assumption that like, oh, I've got auto insurance, so it doesn't matter. I'll just I'll start
Yeah.
picking up some rides here and there and take people to the airport, make a little extra money, not knowing that actually on the back end, like if they do end up getting into an accident, they could maybe potentially not have coverage for that. So
Yeah.
really just depends.
Yeah. And then let's kind of transition on the home coverage side. So just kind of walk us through what your process is for that, some of the pitfalls that you see, any sort of coverages that you will add on to a policy that you don't see frequently. I think that would be an interesting one. And I would say maybe like some things that most people might not consider to insure when it comes to homes. Cause I know you and I have talked about, secondary structures on a home property, things of that nature. And if you can kind of also talk a little bit about the difference in coverage terms. So kind of cash replacement versus reconstruction costs, or reconstruction value. Would love to just kind of have you talk through that.
Yeah. So the home is that's an area where you obviously want to make sure your policy is written correctly.
Yeah.
And where we see a lot of issues are, first time home buyers, for example, like they don't understand that they're going to need water backup if they have a finished basement. So that's kind of on the agent to educate the client, right?
Yeah.
With things that they might need for their home. So really what we do on our side, you send over the declaration page, and we kind of just cross-reference it with both the information that the client has provided us, as well as try to find as much info about it online. And a lot of these county assessor websites actually have a ton of information regarding the dwelling and kind of the specs of it, right? So we want to go through first and just make sure everything makes sense. Like, does the square footage or the replacement cost on the home line up close enough to what the county assessor's website says, or
Yeah.
what Zillow is saying? Now, Zillow, realtor.com, I try not to go too much off those listings. They're really good for pictures and you can see the home, but the information tends to be inaccurate on those because they always include the square footage of the basement. Whereas when running replacement costs on the home, you don't include the square footage of the basement. So
Oh,
it's
that's
like,
interesting. I didn't know that.
Yeah, so they just
Even
want
if it's
the
finished
above
or not?
ground. They want the above ground living area. They don't, and then within the system you put, there's a finished basement that's 80% finished, and that gets calculated in there. So if somebody has a 3,500 square foot home, but 1,600 square feet of that is a basement, Zillow is going to say that home is 5,100 square feet. So
That's robbery.
you can't. So I'm going to go in there and say, if I type in 5,100 square feet, well, the replacement cost is going to be extremely different compared to saying, the home is actually, only 1,900 square feet above ground.
Yeah.
So like things like that, but we'll find people that are uninsured, overinsured, whatever it may be. It just depends on going in and looking at and making sure that the policy they have actually provides adequate coverage. So like a really big example that we've been seeing over the course of the last few years is a cover. It's an endorsement called service line coverage. And basically what that provides is any sort of buried service line in your yard that you as the homeowner are responsible for. This endorsement will provide coverage for that. So the biggest item there, right, is your sewer line.
Sewer, yeah.
So from the main to your home, you as the homeowner are generally responsible for that. So if your sewer line collapses and you have to pay a plumbing company to come out, excavate the lawn, replace that sewer line, that can be sometimes an $8,000 to $10,000, $12,000 repair. People might not have that on their policy. They might not even know about it. And, it's like a $30 a year endorsement. So it's
That's
like, I would
insane.
have it if I knew
$30 a
about
year.
it.
Yeah. Yeah.
Right.
Now, obviously,
So,
quotes are subject to change, but that is such a cost saving thing and just such a small element. And I know a lot of real estate agents that I work with and am friends with. That's one of their biggest concerns that they see that people often don't check when they're purchasing a home is they'll run a test on the sewer line and they'll see how things are. And I think that that's a really important addition to coverage when it comes to, looking at insuring your home.
yeah, absolutely. So, like on our side, so we've got products that cater towards high value homes, right? Any home with like $1 million replacement cost or above, we have markets that will, they only write homes of that value. They won't write a $200,000 house and then turn around and write a $5 million house. They have a coverage A, which would be your dwelling coverage threshold. Then we've got middle market carriers that will be kind of, good for the supplementing the $200,000 to $900,000 homes. That's a very, very competitive space. But then the captive markets, like the State Farms and the American Families, I mean, they'll write anything and everything. So they'll write, there's no minimum coverage A, there's no maximum coverage A. If they can write it, they'll try to write it. The problem that exists with operating with carriers like that is the person who lives in a $2.5 million house is going to have a drastically different claim than somebody that lives in a $250,000 house. And that's not to say, they have a bigger house, so they're, that's like, they are more important, or they, no, it's just from a claim standpoint, there's a lot more destruction. And so when you have these policies that are kind of like a one fit all, they oftentimes, the underlying limits within the contract get capped out really quick, because they'll be like, they'll only pay, we're only going to pay $10,000 for water backup coverage. Well, $10,000 isn't even going to pay the water remediation company to come soak the water up in the basement. So now, you've got somebody that has, this massive finished basement, and then they realize that, hey, we only have $10,000 in coverage for this loss. And because it was that type of loss, once you cap it out, there's nothing else. Everything comes out of pocket. Wow. So we look for things like that. Really, like on the home side, there's a lot of carriers now that are kind of coming into the space. I know you guys kind of didn't really ask about this, but I'll kind of go into it because it kind of goes hand in hand. So we're seeing a lot of the emergence of insurtech carriers lately. So when you think of insurtech, I mean, it's just quick, rapid, really good policies, very competitive premium. these other big companies, the massive multi-billion dollar, they're very slow to adapt and to change, and everything seems to be a process. But we've been having these companies come through, like Openly, for example. They're just super competitive on high value homes, and they're 30-40% the premium of the next competitive market.
Wow.
And they offer awesome stipulations within their contracts that are very advantageous for the insured. Things like guaranteed dwelling replacement cost. So in the event of a total loss, we will guarantee the rebuild of your home up to full settlement, right? So there's no policy cap. Like with Openly, I think it's $5 million, but companies like Nationwide Private Client, they're not Chubb. There's no cap there, right? So your house, heaven forbid, total loss, they're guaranteeing the rebuild. Whereas some of these other companies, they might only, insure it up to the aggregate limit, and then maybe 10% after, or 25% more coverage that extends on the back end. But just having like companies that will just we'll just guarantee it. That's massive. And we're seeing a lot more of that right now.
And Sean, correct me if I'm wrong, but that's a huge benefit of working with a broker such as yourself versus a captive agent, because captive agents can only work with what they got. You can go out and find the best policy wherever you can find it.
Exactly. I mean, if you're able to give us all your cards, we're going to make you the best hand. Whereas when you can only draw from one pile and take their cards, you get what you get.
Yeah.
And with a lot of people who don't actually, read the ins and outs of their contracts, they just, you don't know until you have a claim, right? You don't know what you've bought until you have a claim. So that's why it's important to work with agents that are actually doing a risk analysis on the insured. Like, do you actually have a risk here? If you don't have a finished basement and you don't store anything down there, and if you get a little bit of water backup, you can take care of that yourself. You probably don't need to have that coverage. But then you might look at their current home policy, and they might have $50,000 of coverage, and they're paying $300 a year for it. They're like, okay, well, there's no risk exposure there, and we're going to remove that. We're going to cut costs there. But then also at the same time, you educate them like, hey, if you do finish this basement out, let us know. We'll put it back on.
Yeah.
So. Yeah. And I think that kind of plays into the idea of firstly, having a good relationship with your insurance agent, and also getting educated on when you need to reach out to update coverages and have that conversation again.
It's always good to reach out. So, a lot of people also don't realize, like, after your roof turns a certain age, with most insurance companies, it's 16 years or 21 years is the cutoff. They'll actually change the loss settlement on your roof type to actual cash value instead of replacement cost. So when I say replacement cost, if we're talking in terms of a roof, let's say a big hailstorm comes through and it totals out the roof, right? You need a new roof. Most people assume that their policy pays out on a replacement cost basis, which would be the cost to replace the roof minus your deductible. That's how everybody thinks about their policy. When actually there's a chance that you could have a roof that pays out actual cash value. So that factors in the depreciation. So it'd be the cost to replace the roof minus depreciation minus your deductible. So let's take a 30-year, just composition roof or architectural shingle roof. And let's say it costs $20,000 to replace, and you've got a $2,500 deductible. This roof is 16 years old. So now it gets flipped over to actual cash value for the loss settlement. You have a loss. The roof costs $20,000 to replace. Well, this thing's about halfway through its life. So we'll just consider it, for the sake of easy math, $10,000 of that is depreciation, right? Because it's 16 years old now. So it would be a claim there would pay out $20,000 replace the roof, minus $10,000 because of the depreciation, then minus your $2,500 deductible. So you're looking at getting paid out
$7,500 in cash value.
And then you pick up the other 12,500. And so, carriers will bury really, things inside the contract like that, or, they might send you documents in the mail letting you know that that's going on, but it comes with your renewal, and that's 100 pages. And, they might be on page 3. Hey, by the way, we're flipping this over to ACV. You got to make sure you have people that catch that stuff.
Yeah.
Yeah. I think that's so important. And secondly, it's for most Americans, your personal residence is your largest investment from a net worth perspective. And making sure that investment or that asset is properly insured is just incredibly important.
Exactly. Yeah. And, the thing with insurance is you want, when the time comes to use it, you want to make sure that it actually comes into play.
Yeah.
At people, every day we see it. People will say, I was with X insurance company and I had a horrible claims experience. And it's like, oh, because, you finally had to use your insurance and you realize what you bought wasn't adequate for what you needed.
Yeah. Yeah. And let's kind of transition. Actually, before we transition umbrella, Kyle, I know you wanted to talk renters landlord insurance. Feel free. I'd love to have you ask kind of Sean a couple of questions about that.
Yeah, I mean, I'm in an apartment right now. I have renter's insurance, and I just have it because that's what I was told I needed. So as far as I understand it, it's not like I am insuring if there's damage to the roof and it starts flooding through. But in that instance, I am insuring my personal belongings within my apartment. So is that just really, what do you know about rental insurance? And is that really as far as it goes?
Yeah, renter's insurance is it's going to cover your personal property. It's going to give you a little bit of coverage for if you're displaced due to a covered loss. So say you have a partial fire and you need to rent another apartment because you can't live there. So there's going to be some loss of use coverage in there. It's also going to have liability coverage, which is important. So just like how your homeowner's policy would have liability coverage, you also have that as a renter. Now, things normally, the big liability claims that you see that stem from renters policies or homeowners policies are slip and falls and dog bites. So, there is coverage there for you in that situation. So a renter's policy definitely serves a purpose. If you have a golf game like me, the second you tee off on that first hole, my homeowner's insurance policy is always in play because that ball's going wide right and I'm going over to the 8th hole and I'm going to have to go apologize to the group of carts I almost just hit. It's taking time, right? But if I hit somebody, that could technically be a homeowner's claim or a renter's insurance claim via liability.
Interesting.
Okay. So the big thing with renter's insurance is just making sure that you're just taking an inventory of what you have. And I tell this for homeowners too, right? The best time to take inventory is when you're moving or moving in. You just take pictures of your stuff. They come in, that will pay dividends for you if you do end up having like a fire or some sort of just massive claim, like here in Kansas, tornado. We could have that risk. If all of a sudden your things are gone, the insurance company is going to ask you what you had, right? Yep. So you got to be able to, you got to be able
like
to
off the top of your head. If you don't have pictures, you have to like mentally account for everything in your home.
Right, exactly. So if you're like, hey, I lost my coffee maker, well, they're just going to go to their list and okay, coffee maker, $10, Mr. Coffee Pot. But if you're like, no, I lost my, Nespresso, that's completely different. So that, personal property, inventorying it, that's going to be anything. You take the roof off your apartment, turn it upside down, shake it, everything that falls out is going to be your personal property, right? Yep. So laptops, if you have really kind of like higher end like equipment or cameras or electronics, I might look at maybe individually itemizing those with the insurance company. You'll pay a little bit of a premium on there, but it's also going to, it'll come with a $0 deductible and things like that.
On exactly that note, going back to the homeowner's policy, I've been thinking about this. I've got clients with very expensive artwork or personal belongings. Is that something that you can itemize on your homeowner's policy to have separate coverage for? Jewelry, anything like?
Absolutely. So any sort of collections, jewelry for sure, artwork for sure, silverware, any sort of collections like that, you're going to want to schedule because most likely for items like jewelry, there's going to be a cap. Like I know going through like some of these captive carriers, they'll pay out, the maximum that they'll pay out is $1,500 per item, and the max that they'll pay out for in total is $2,500. So if you have, let's say, 2 Rolexes and then your wife's engagement ring, and you're on vacation, she leaves her ring at home, thief breaks in, steals the watches and the ring, well, then it's like, hey, my Rolex is $12,000 each, and my wife's wedding ring was $20,000. What do you mean we only have $2,500 in coverage? It's like, yeah, well, that's how much that jewelry pays out from our underlying limits. So those items you always want to schedule, and when you are scheduling them, I actually don't like putting jewelry with the homeowners insurance company that you have that through, unless it's on a separate policy. A lot of people we find make the mistake of insuring their jewelry with their home. So they just endorse it onto the home. Well, the problem here is if you ever have to file a claim because you went to the lake and you jumped in and you didn't realize you were wearing your ring and you came back up and it's off, and now you have to file a claim, that's going to actually show up as a homeowner's claim. So it's going to influence your homeowner's rate when you could have just had it scheduled out, paid virtually close to the same premium as you would have having it scheduled underneath the homeowner's policy. But now it's not going to show up as a claim because it's separated out.
Interesting. Yeah, I've never heard of that before. It's just kind of having like a secondary policy, like a side policy for any sort of expensive art, jewelry, plateware,
exactly,
or anything like that.
So there's companies that just specialize in only insuring jewelry. Like Jewelers Mutual is a massive company that does that. They do a great job. Unfortunately, they don't work with brokers anymore, but they like if you go to like a Shane Co. or any jewelry store, they'll probably send you to either like a Bright Co. or a Jewelers Mutual. Like they do a really good job of educating their consumers to say, hey, get this insured separately. But a lot of people don't know that's how that works. And so, they say, hey, I've got a $10,000, wedding ring, and they'll just endorse it on the home policy. And, there's going to be coverage there, but, if you just would put it with a separate company, you still have the coverage, and then you don't have any of the, negative fallout effects of actually having to file a claim for that.
Yeah. Okay. So kind of transitioning in the last part here, and I'm sure we could talk umbrella for hours, but umbrella, just walk us through why umbrella is important, who it's important for, and just kind of how that process works of paying out claims for umbrella when something else is exhausted.
Yeah, exactly. So umbrella, I view as a necessity. You need to have it. There's no better or cheaper way to protect yourself from a liability standpoint than by having an umbrella.
Yeah.
So what an umbrella does is it's going to think about an umbrella, right? What's it do? It covers you. So it's going to cover all of your exposures. So your home, your auto, the drivers in the household, boats, any RVs, toys that you might have, secondary locations, any risk exposure that you have that has liability on a personal line standpoint, it's going to cover that. And so if you, with your underlying policy, so let's say you have an auto policy, an underlying auto policy, and you've got a husband and wife, and they've got 2 cars. So it's going to cover both the drivers. It's going to cover both the cars. On that auto policy, you're going to have limits of liability. Like we discussed earlier, some people have state minimum, $25,000 in coverage per person, $50,000 per accident. With an umbrella, you generally have to have there's going to be like 250,000, 500,000, depending on the carrier, would probably be the minimum amount of liability coverage that you would have to have in order to have the umbrella.
Got it.
So let's take a carrier like Travelers, right? You have to have $250,000 of bodily injury liability on your auto per person and $500 per accident to be eligible for an umbrella. So once you have that, if you exhaust that liability limit of $250,000, that's when your umbrella is going to come into play. So a really big kind of situation where we see this a lot is obviously auto. Like those can be really, really bad claims, right? And if you only have $250,000 in coverage and it just caps out there, that might not be enough coverage for you still, right? So the example I always like to give, because this is something that I think everybody can relate with, is you're driving down the highway and somebody comes on a motorcycle shooting up next to you, right? You're
Yeah.
not really paying attention. You don't know that this guy's to your right. He might be in your blind spot, whatever it may be. You merge lanes, you knock him off his bike. The guy, rolls down the highway for a little while, has a bunch of, road rash, all that, hits his head, whatever it may be. In Kansas, I don't even think it's a law. They don't have to wear helmets, which, guy
It's
hits
crazy.
his head, has, a head injury. Like, he's going to exhaust that $250,000. Now, depending on who is at fault, if you're at fault, say you're texting, you were speeding, driving intoxicated, whatever it may be, that guy is going to have his medical bills. And then when he's done, he's going to sue you, right? He's going to get a personal injury attorney. They're going to come after you because, he might be permanently disabled. He might not be able to work anymore. He might need physical therapy, all this stuff. So where's that money going to come from? And that's kind of relating back to the first part that we talked about, depending on, state by state, what's actually in play from a risk exposure standpoint. Right.
Yeah.
So Missouri, the laws are going to be a little bit more relaxed on what personal injury attorneys can go after compared to Kansas. So, what's actually going to be in play here? And so with an umbrella policy, if you are a high earner, you say you have a high earning occupation, like a physician, but husband and wife are both physicians, or they're both attorneys, or whatever it may be. The courts might recognize, hey, you have 30 years to work still, and you're making hundreds of thousands of dollars. Your wealth's only going to continue to grow. Like, we're just going to garnish wages until you pay them back. If you don't have that umbrella there, if you do have the umbrella there, that's going to be $1 million increment. You can buy them all the way up to 25 million. But most carriers after 2 or 3 million, they'll make you go through underwriting and justify why you need a $25 million umbrella.
Yeah.
But you exhaust those limits of liability, the umbrella is sitting there behind to provide you with $1 million or 2 million, 3 million. And the thing is it's cheap. It is not expensive to buy. If you're looking at the exposure that I gave, two people, husband, wife, 2 cars, 1 home, you're looking for $1 million umbrella, maybe $200 a year. If you have accidents and claims, maybe $300 a year. There's just no better way to protect yourself. It's something I highly recommend. It doesn't matter if you're just renting. It doesn't matter if you're, a multimillionaire. I think everybody should have one.
Yeah.
Yeah.
For
And
sure.
I always hear like the example of like, when you get a pool on your property, especially, you start having people over, you never know if someone slips by the pool. I mean, we had a trampoline growing up and kids got hurt on that thing all the time. So
Yep.
that's another big one.
Yeah, exactly. And with the homeowner's policy, if you've got personal injury that's automatically included or it's endorsed, and then you have an umbrella, they'll pick up the libel. They'll provide coverage for libel, slander, defamation, things like that. So umbrellas can come into play for that as well. So
yeah. And to kind of just like sum up the episode here, on the auto side, just making sure that you understand your risk exposure and working with somebody that can help you figure that out. And, on the home side, making sure that you're protecting your most insurance, your most important asset when it comes to your net worth is so important. And Sean, I really appreciate you talking about the idea of, especially if you have any sort of nice jewelry, belongings, things of that nature, splitting that coverage off of your home policy. So if in the event that something does happen, you are not making a claim against that homeowner's policy. And then umbrella is just for the cost of coverage and the amount that you can have. It's just such a safety net, in my opinion. In situations when stuff happens, having that umbrella policy is so important, because I think that's a really good point that you made about the motorcycle incident. Is most people are, and I want to use this lightly, but most people are too nice to think that the insurance situation stops at medical, right? Because if somebody is medically injured, they are gonna go after you.
right.
Most cases.
They have to.
They have to.
They
Yeah. And because it in a way, it's free money. It happened. We might as well get it.
Lost wages, yeah.
Well, it might not even be money related. It might just be your coverage doesn't cover all of their medical bills. Like
Exactly.
that might not be them wanting to just get a quick payday. It's like, hey, I had $600,000 in medical bills, and you only have $100,000 that pays out.
Yeah.
So I have to come after you for the other 500,000.
Yep.
Yeah. Yeah. It's just so important. And you know, this, when we ask the question, who is this important to? It's essentially everybody.
Correct.
Everybody that is outside of college that has their own car, is renting an apartment, or has their own home or multiple homes. And, you know, working with somebody like Sean that has the ability to help you understand your risk exposure and navigate your insurance situation as life changes is super important. So, Sean, really appreciate the advice, the insight, the guidance you provided today. If anybody has any questions, feel free to reach out to us. You know, we're happy to connect you with Sean. Sean, are you social media wise? Are you on LinkedIn? Anything like that?
Yeah, I'm on LinkedIn.
Yeah. And we'll definitely get you tagged on here.
Yeah.
I'm sure it's brushcreekpartners.com. Is that the website?
It's brushkc.com.
Brushkc.com. So if anybody wants to reach out to Sean, feel free. If anybody has any thoughts or ideas that they'd like to hear Kyle and I talk about here on future episodes, please feel free and reach out. We'll have our contact info wherever you're seeing this. And we really appreciate everybody watching and listening. And we'll see you next week.